How would you rate your willingness to try new things? Most people, myself included, are creatures of habit that just don't like change. We stick to what we know because we're comfortable, knowing that the majority of what we do in our day-to-day doesn't have any unexpected surprises. On the flip side, some people are adventure seekers. They really enjoy spontaneity and even the experience of going through those uh-oh moments when things don't go according to plan. The biggest doozies are what make the journey memorable. They might not be funny then, but they give you something to laugh about afterwards, because that is what puts a personal touch on an experience that nobody could have ever expected. Trying new things might be difficult for many, but the beautiful thing about each one of our experiences is that no matter what we're good at or comfortable with, we were all once beginners. The same is true in investing. We tend to try new things when we can see the purpose in the outcome. We keep things going when the reward outweighs the work. It's worth it. If you overthink things, you probably won't even start. If you oversimplify and expect that there's no sweat to be put into it, then you're likely to quit shortly after you start. Investing is no exception. There's a spectrum of investing that goes from low risk, low involvement to high risk, high involvement. You don't hear the majority of passive investors complaining about how time-consuming investing is. That's why they chose passive investing. It most often comes from active investors with really high expectations, but maybe not the true understanding of how much risk their expectations bring them. Most active investors would reasonably agree that value investing based on financial fundamentals does have merit, but it either takes up too much time or forgoes too much opportunity from those up-and-comers. Companies that have great growth potential, but maybe not necessarily the financial stability to be deemed a worthy investment as a value investor. What if I told you that analyzing company financials doesn't have to be so time-consuming, that you don't always have to start from scratch? What if value investing could be simplified in a way that you could rinse and repeat a process for all companies, regardless of company size or industry? Here are 2 techniques to standardize and scale your financial analysis. The first technique is the power of averages. We know that an average is a single number that is used to represent a collection of numbers. The power of averages tells us that this one number accounts for all numbers in such a manner that it smooths out outliers. What this means for you is that when you look at financial statements, you can use the power of averages to smooth out all figures over many periods of time to create one number, a baseline, to compare against. We talked about financial velocity, where we can compare how the most recent period is moving relative to the average of all periods. This gives us another perspective of how a company is performing. Some look at one quarter over another, but seasonality skews this picture. If a company is in a peak season, it always tends to look better than the quarter before. If it's coming off its peak season, it looks worse. We also learned that comparative analysis looks at same period over last year so that it's apples to apples. The challenge there is that it's got blinders on for everything that happened in between. Would it be important for you to know if there were these astronomical wild swings in between those 2 periods? This might be worth considering. The power of averages allows us to account for all periods, even comparative periods, with one number that smooths out the outliers. So what do you do when you've gotten into the rhythm of applying metrics to many lines on the financial statements? It becomes too difficult to manage or even make sense of, right? The second technique is called standardizing numbers. This means putting numbers on the same scale so that you can compare all the different metrics you've made in one uniform way. We talked about financial relativity and financial velocity. Those are converted to 0 to 100 numbers like a math score. They're standardized. The simple point to remember about standardizing a number is to identify a baseline that you can use to common size each metric into a uniform 0 to 100 scale. Take current ratio as an example. This is current assets divided by current liabilities. If I want to standardize current ratio, the first question to ask is, what do I want the baseline to be? I want a 1.5 current ratio as my baseline. Perfect. If the current ratio actually turns out to be a 1.5, divide that by the baseline and multiply that by 100 to get a perfect score of 100. You can get creative from there and set rules like, I don't want the standardized score of a current ratio to be greater than 100. Or if you have metrics that go negative and you want to keep it between the 0 to 100 goalposts, then you could set rules to say, I don't want the standardized score of financial velocity to go below 0. Now, back to that question. What do I do when I have like 20 different metrics that I've standardized on a company's financials? The power of averages will bring it all home to give you that one uniform number that considers all metrics and smooths out the outliers. Let's do a real example. Arista Networks. We're going to score this company on a scale of 0 to 100 just by looking at a handful of lines on their financial statements. Revenues, earnings per share, current assets, and liabilities. This is sales, profitability, and liquidity. I want to look at 5 quarters. That way the most recent quarter has a comparative quarter, and I am accounting for everything in between. I'm going to measure financial velocity and relativity on sales and EPS. For the current ratio, I want the company to have $1.50 in current assets for every $1 of debt it has in current liabilities. So my baseline for current ratio, 1.5. Now, I want to be very picky, right? So when I calculate financial velocity, I want a trend of 10% growth each quarter. So my baseline, the most recent period divided by the average of all 5 periods, 1.2. Pretty aggressive, right? Let's see how Arista Networks stacks up. At the time of this recording, it's April 30th, 2023, the day before Arista will report its first quarter earnings. Last quarter, not only was it a record month in revenues and EPS, but every single quarter delivered back-to-back record performances. Right off the bat, I can see that for both sales and EPS, the financial relativity scores are perfect 100s, record highs. Now, velocity. I divide the most recent period by the average of all 5 quarters for revenues, which gives me a 1.23 and a 1.35 for EPS. I divide both of these by my 1.2 baseline, multiply that by 100, and I get a score of 102 for sales and 113 for EPS. Not bad at all. Now, last but not least, current ratio. I want $1.50 in current assets for every $1 of debt in current liabilities, right? So I take their $5.6 billion in current assets and divide it by their $1.3 billion in current liabilities. This gives us a whopping current ratio of 4.3. That's more than double of what I was expecting for a solid company. Standardized liquidity score, 100. It would have gone over 286, but I'm capping it 100 because you don't get brownie points just for holding a lot of cash. You do get brownie points for growth if it was for the top or bottom line. That's about it. So now that I have 5 numbers, 102, 113, 100, 100, 100. So what does that all mean? Well, it means that this is a rapidly growing company with consistent growth to its top and bottom line. It's delivered impressive, record-setting performances that are accompanied by very strong cash positions and healthy debt levels. We can use the power of averages to bring all 5 numbers together into one. For Arista Networks, their overall financial performance over the past 5 quarters is a 103, a very strong A+. So how much did the stock price grow over the past year from April 30th, 2022 to April 30th, 2023? 32.6%. How much did the S&P 500 move in the same time? It shrank by almost 10 points. In 1 year, Arista Networks significantly outperformed the S&P 500 and grew in a time where the markets overall pulled back in a tough economy. At the time that this episode was filmed, Arista closed at $156.76 per share. They report earnings tomorrow, and their guidance is impressive. We will see if they deliver on those earnings estimates and how the market reacts to their performance. Will strong performance stand out in difficult market conditions, or will it be suppressed and undervalued? Will poor performance be amplified, or is that par for the course? Friends, trying new things is tough. Whether it's something easy like a new hobby or something ambitious like investing, there's always this question we're trying to find an answer for. What is the point of all this? All of us have a story about a time we tried something new for the very first time. But the things that we stuck with, there is a specific moment where something clicked. It was that eureka moment where we saw the value and the purpose of whatever this new thing was, and we decided that it was something worth holding on to. At that moment, it didn't seem intimidating anymore. It may even spark that passion where you want to share it with other people too. Breaking down big things into small steps with techniques like these are what make even the most complicated things something that more and more people can start to learn. So is it actually possible to build a standardized and scalable strategy to tie stock prices with financial performance? Can we use this to determine whether something is undervalued? Until next time, I'm Jonathan Wang. Stay sharp. Stay safe, everyone.